This is Mark to Market, a podcast of BT Correspondents.
Hello, everybody. Welcome to Mark to Market, a BT Correspondents podcast that aims to provide analysis and insight on market trends and corporate issues in Singapore. My name is benpaul, and I'm a senior correspondent at the Business Times. Every week, my colleagues and I delve into a business story that matters. We're in the month of February 2026, and one topic that has drawn a lot of public interest here in Singapore is the performance of the country's sovereign wealth fund GIC and investment company Temasek, or rather, the underperformance of these two stewards of Singapore's national savings versus their peers around the world. Back in December last year, the Financial Times ran a full-page article about GIC and Temasek, which said, among other things, that their returns over the past decade had trailed some of their well-known global peers, such as the New Zealand Superannuation Fund and the Canada Pension Plan. The following month, in January, several questions were raised in Parliament about whether GIC and Temasek have been generating satisfactory risk-adjusted returns and whether their contributions to the national budget can be relied upon. Responding to these questions, Senior Minister of State for Finance Jeffrey Chieh said that the government assesses GIC and Temasek's performance primarily against their respective mandates and risk profiles, and not against the performance of other funds. And on that basis, the returns generated by GIC and Temasek have been reasonable and within expectations. Nevertheless, he acknowledged that GIC and Temasek could have performed better. For instance, he noted that Temasek's investment returns were affected in recent years by the weak performance of the Chinese market, though this was mitigated by higher returns from its growing investments in Europe and the US. He also noted that GIC had preemptively moderated its risk exposure in anticipation of increased market volatility and heightened valuations. These measures were intended to keep GIC's portfolio risks within acceptable limits and to guard against the possibility of significant asset impairment in the event of a sharp market correction. However, as it happened, equity markets continued to remain elevated, and GIC's prudent de-risking measures resulted in some foregone returns. Now, the government's full responses to all the questions raised in Parliament last month about GIC and Temasek are publicly available. In fact, you can watch the proceedings that took place in Parliament on the 12th of January, which is when these questions were addressed, on the Ministry of Digital Development and Information's YouTube channel. Transcripts of Jeffrey Chieh's responses in Parliament are also available on the Ministry of Finance's website. So if you're interested in exactly what was said, you should check it out. My own sense is that the questions about GIC and Temasek's performance aren't going to stop. After all, the returns generated by these institutions are integral to the national budget, and if their risk-adjusted returns are lower than they ought to be, then it is certainly something that the government ought to address. However, it would be a mistake, in my view, to simply push GIC and Temasek to deliver higher returns, especially at this stage of the global market cycle. With elevated stock valuations and an uncertain outlook for global growth and inflation, this is probably the wrong time for long-term investors to embrace more risk. Instead, it might be better to address the doubts about GIC and Temasek's performance, at least initially, by making more information about the internal workings of these institutions available to the public. A broader awareness of their unique mandates and risk profiles might help everyone better understand why their returns have not been higher. Now, to be clear, I'm not defending the track records of GIC and Temasek or suggesting that nothing should change. I'm just saying that there should perhaps be a deeper discussion about how they manage their portfolios before trying to come up with a remedy. Now, I'll talk more about this later in this podcast. But let me first delve into the information that is already available about GIC and Temasek. GIC's stated aim is to preserve and enhance the international purchasing power of assets under its management. It maintains an overall risk boundary of a portfolio consisting of 65% global equities and 35% global bonds, though it invests in a broader range of asset classes. As at the end of 31st March 2025, GIC had a 51% exposure to equities, 26% exposure to fixed income assets, and 23% exposure to real assets. The year before that, as at 31st March 2024, GIC had an even lower exposure to equities, just 46%, Its exposure to fixed income then was 32%, and its exposure to real assets was 22%. For the 20-year period up to the 31st of March 2025, GIC reported a nominal annualized US dollar return of 5.7%. For the 10-year period up to the same date, it reported an annualized US dollar return of 5%. By comparison, the reference portfolio that I mentioned a moment ago, consisting of 65% global equities and 35% global bonds, delivered a higher annualized return of 6.2% over the 20-year period and 6.4% over the 10-year period, in both instances with higher levels of volatility. For the record, after adjusting for global inflation, GIC's annualized return for the 20-year period to the 31st of March last year was 3.8%. On the other hand, Temasek is a rather different animal than GIC. It started out as a vehicle to hold a clutch of government-linked companies, and it is now an active bottom-up global investor with a net portfolio value of $434 billion as at the 31st of March last year. Of that net portfolio value, 41% consisted of its stakes in listed as well as unlisted Singapore-based portfolio companies such as DBS, Singtel, Keppel, Mapletree Investments, and PSA International, just to name a few. A further 36% of Temasek's net portfolio value consisted of global direct investments. These were largely equity stakes in companies aligned to four structural trends, namely digitization, sustainable living, future of consumption, and longer lifespans, and they included stakes in companies such as Dutch fintech Adyen, Indian hospital operator Manipal Health Enterprises, and Chinese technology giant Tencent. The remaining 23% of Temasek's portfolio last year comprised its interest in various partnerships, funds, and asset managers. Now, one interesting thing about Temasek's portfolio is that about half of it, or 49% as at March 31st last year, consisted of unlisted assets and funds. Temasek's annual report last year stated that these unlisted investments generated returns of 7% per annum over the preceding decade and more than 10% per annum over the last 2 decades. It said this was higher than the returns generated by its listed portfolio, which is not surprising because unlisted assets are less liquid and tend to offer higher returns. Temasek's headline total shareholder return for its whole portfolio, however, was only 5% per annum over the 10-year period to March 31st last year and 7% per annum over the longer-term 20-year period. Over the same 10-year and 20-year periods, the MSCI All-Country World Index returned 9% and 7% per annum, respectively. Given these numbers, it's perhaps understandable why questions are being asked about GIC and Temasek's raw performance, especially over the past 10 years. Why have they not performed better? And what, if anything, should be done about it? I'm going to talk about that next.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Claressa Monteiro in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Market, a podcast of BT Correspondents.
One of the biggest stock market trends over the past decade has been the very strong performance of the US market, driven by the rise of a handful of mega-cap technology stocks, including Apple, Alphabet, Amazon, Microsoft, and more recently, Nvidia. One consequence of this trend is that it's been hard to outperform some of the big market indices, including the MSCI All-Country World Index that I mentioned earlier, without having large exposures to these heavyweight US stocks. In fact, at the end of last year, 9 out of the 10 largest constituents of the MSCI All-Country World Index were US megacaps, with a combined weighting of 21%. In total, US stocks had a combined weighting of about 63% in the index. Back in January 2014, according to a report that I've seen, US stocks accounted for only 49% of the index. The way I see it, GIC was not wrong to have adopted a more cautious stance against this market backdrop. As I mentioned earlier, GIC's exposure to global equities increased from 46% to 51% during the year to the 31st of March 2025. Its overall exposure to the Americas increased from 44% to 49% during the period. In its annual report last year, GIC noted that some headline market indices had become highly concentrated in certain countries and sectors, and because of that, its investment teams were looking at absolute return or total return strategies beyond market indices. It also said its public equities team were focusing on high-quality companies that can compound in value over the long term, and that it's paying extra attention to risk management and position sizing, and that it's ready for dislocations and opportunities in the market to provide financing for businesses that require additional capital to adapt to the fast-changing environment. While a prudent stance resulted in GIC not performing as well as it could have, its capital preservation instincts make lots of sense to me in the market climate of the last few years. The way I see it, GIC should perhaps provide more granular information and case studies on specific investments it has made in order to foster broader awareness of how it invests and how it evaluates risks and opportunities. Given its long-term focus, this information does not necessarily have to relate to its most recent investment activities, but to key investment decisions in the past that have contributed to or detracted from its performance over time. This isn't really a big ask. GIC already provides extensive general information about how it constructs its portfolio, how it manages risk, and even how it approaches the issue of sustainability. Giving the public specific examples of exactly what it has invested in and how these investments generate returns could go a long way in helping everyone better understand its performance and determine whether anything needs to change. This brings me to Temasek, which, because of the nature of its investments, actually does provide quite a lot of granular information about its portfolio. In fact, every year, when the Temasek Review comes out, I go through it and make a note of the more exotic and far-flung companies in its portfolio and try to educate myself about their businesses and financial performance in order to understand what Temasek sees in them. One aspect of its portfolio that clearly shapes its overall performance is its very big exposure to some of the largest companies in Singapore. As I mentioned earlier, these Singapore portfolio companies accounted for 41% of its net portfolio value last year. And keep in mind that these are listed as well as unlisted companies. In fact, its unlisted Singapore portfolio companies accounted for 29% of its total unlisted assets last year. As the controlling shareholder of these companies, with an indefinite holding period, Temasek's primary goal is to help them become better companies with high-caliber boards, strong management teams, credible business strategies, and optimized capital structures. Temasek isn't just concerned about financial returns from these companies, but also whether they're adapting their businesses to a changing world and the emergence of new technologies. Some of these companies also serve Singapore's national interests, even if they don't deliver great financial returns. Take Singapore Airlines, for example. In my view, SIA is a great airline, but airlines are generally not great investments. Nevertheless, SIA is a crucial part of Singapore's air hub ecosystem, which supports a wide range of other businesses. So, when the pandemic struck, there was no question that Temasek would do everything it possibly could to support the airline until international borders reopened. Now, I'm not suggesting that Temasek's Singapore portfolio companies are not being run on commercial terms. They certainly are. However, I think it's fair to say that Temasek is structurally tied to these companies and that these companies will remain a major part of its portfolio for a long time to come and strongly color its overall performance. This isn't necessarily a bad thing. In fact, since the pandemic, many of Temasek's Singapore-listed portfolio companies, such as Keppel, Sembcorp Industries, and Singtel, have unlocked value and repositioned their businesses, delivering very strong performance in the process and contributing to the renaissance that's currently unfolding in the local market. The way I see it, providing more information on the performance of this key segment of its portfolio, as well as the performance of its global direct investments and the performance of its various partnerships, funds, and asset managers, could help the public better understand its overall performance and figure out whether anything needs to be fixed. As it happens, in April, Temasek will place the management of these three key segments of its portfolio under three separate units. The revamp could result in each of these three portfolio segments receiving more focused management attention, and it could pave the way for Temasek to report the performance of each of these portfolio segments separately. So again, my suggestion that more information be made available is not a big ask. It's very much in line with what Temasek is already doing. In my view, the availability of more detailed information from GIC as well as Temasek could lead to a deeper and more nuanced understanding of their performance and foster greater familiarity and trust among its stakeholders. That's it for this edition of Mark to Market. BT Correspondents will be back next week with wealth editor Genevieve Kwa, so please keep listening. If you have any thoughts or questions about the show, email us at btpodcasts@sph.com.sg. I'm benpaul. As always, thank you for listening and join us again next week.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.